How you all doing today? I see a few sore heads out there from last night. Yeah, a little bit of nodding in the crowd. It's a long week, people. Take your time. Okay, so the topic of today is lifting the lid on liquidity. So at Auros, for those of you that don't know who we are, we're a market maker and high frequency trading firm in crypto. And we've found that liquidity is the number one reason why good projects tend to fail. So people tend to focus on team and culture and technology and go-to-market strategy, and all those things are great, but if you don't have a bona fide, concise liquidity strategy for your token, then you are doomed to failure. Before we get into it, just a bit of background on myself. I started my career at a company called Optiva, which is a large high-frequency trading firm based in Amsterdam with offices around the world. Spent time trading derivatives, spot, FX. Found myself then about halfway through my career on the buy side. So I worked for a couple of hedge funds in New York, First New York and Hudson Bay. And what I found was I found a new appreciation for the difference between good liquidity and bad liquidity. So coming as a liquidity provider, I was on the maker side of a lot of these transactions. Moving to the taker side, in my 3 or 4 years in New York, I went from using about 12 market makers for my trades to using just 2. There were only 2 people on the street that I thought could offer the consistency of liquidity and the spread and the depth and were going to stand by their quotes at all times. Fast forward, I joined Kinetic, which is a crypto firm in Hong Kong in 2017, and then co-founded Auros in January of 2019. Few little facts about our firm. Fast forward to today, we've transacted $2 trillion of notional value across spot, futures, perpetuals, options, and exotics. We consistently rank in the top 5 of all market makers across all major centralized exchanges, and we account for between 3 and 4% of global crypto volume. Just rewinding back to a few of the milestones of the firm. As I mentioned, founded in 2019. There were 6 of us there with a focus predominantly on high frequency trading and fully systematic transacting. We reached $1 billion for the first time in a day in 2020. And just to put that in perspective, we were trading several times that every day by 2021. So we saw an exponential growth in our transactions, our revenues, and our headcount throughout 2020 and 2021. Around this time, I'd been speaking to a number of folks in the industry, and they were fairly underwhelmed by some of the service quality of some of the token market making providers in the space. We kind of got together at the firm and we thought we could leverage the technology and the experience at our firm to provide a better level of service to token projects. So in 2022, we established our strategic market making business, and fast forward to today, we serve dozens of different token projects with more coming on every week, every month. And the headcount of the firm is now between 60 and 65, with a lot of that growth coming in that strategic market making business. Now, before we dive into all the meat, if there's one thing that I want you all to kind of come out of this with, it's that liquidity can make or break your project. Going back to what I mentioned at the beginning, a lot of people focus on the team and the technology and the go-to-market strategy, and all of these things are important. But if you don't have a clear and concise liquidity strategy for your token, then your chances of success are significantly diminished. So, before we talk about liquidity, just in general, the token economy is a little different to, say, equities, right? In equities and traditional asset classes, you tend not to have too much of a reflexive relationship. You have fundamentals that then tend to drive asset prices. There's a little bit in reverse, but not too much. It's typically a one-way street from fundamentals to asset prices. Crypto is a little bit different. In a token economy, the token itself and the health of that token is fundamental to the value of the ecosystem. So you get this reflexive environment where if you have a healthy secondary market for the token, you get more adoption in the ecosystem, which leads to a further increase in liquidity in the secondary market and so on. And And the opposite of that is when you have a dearth of liquidity, it drives people away from the economy, which creates a further dearth in liquidity and the doom cycle down to zero. Good liquidity can protect market participants as well. So what you want to see out of a liquidity provider is continued liquidity in good times, in bad, in up markets, in down markets. And what that leads to is increased confidence, and it will attract long-term kind of sticky users and capital. And that's what you want. That's what you can build on as an ecosystem and as a token project. You need to build and leverage on the sticky capital that comes in, because fast capital, if it's fast to come in, will be fast to leave as well. So how do we define quote-unquote good liquidity? So there's three metrics that we use. They're fairly well discussed, but not particularly well understood. So there's spread, there's depth, and there's uptime. So what we mean by spread is the difference between the best bid and the best ask in the market. What you want to see in any secondary trading market, and especially in crypto, you want to see a consistently tight spread. So if you want to transact, if an investor or a user or somebody entering the ecosystem wants to transact, you want a tight spread. You want to be able to transact with minimal slippage. Depth is how you kind of measure the amount of slippage for a large order in the market. So let's say I wanted to transact $50, the spread might be very tight, but let's say I wanted to transact $50,000, the spread is going to be a lot wider. It's what when you look at decentralized exchanges, it's essentially an algorithmic formula that determines the slippage based on the TVL in a pool. That's for decentralized exchanges. For centralized exchanges, it's the job of the market maker to provide that depth and ensure that slippage is minimized for large quantity of orders. And then uptime is kind of a reliability metric. How much of the time is the market maker there providing a tight spread and deep liquidity? It's all well and good if times are good, volatility is low, and if the market maker says, okay, now I'm going to go in. But that's not much good when the market gets super busy, volatility increases, if the market maker then pulls away. So uptime is kind of a reliability metric for spread and depth. In terms of what we see as kind of the three core pillars of what we define as ethical market making. So number one is accountability and transparency. Accountability, what we mean by that is a liquidity provider shouldn't just be there when it's convenient for them. A liquidity provider needs to be there at all times through volatile markets, quiet markets, up markets, down markets, and that needs to be enforced via contract. One of the reasons we got into the space in 2022 was because we'd been told by a lot of our partners and portfolio companies that the market makers that they use, the incumbents in the space, were using a quote-unquote best endeavors model where they would provide targets for projects, but where those targets weren't contractual, where there was nothing binding or obligating that market maker to provide that. So what tends to happen is it's there when it's convenient, but when it's not convenient, the market maker's not there anymore. So that is accountability. We think that that's a key tenet of good market making, is it should be contractual and there should be accountability to the market maker and remedies for the project if the market maker fails to deliver. Transparency is fairly self-explanatory. Daily or weekly reporting, constant communication. The liquidity provider needs to be the eyes and ears for a token project and for an ecosystem. They're the ones, with their ear to the ground in the secondary market. They know what's going on. They should be in constant communication so that token projects and foundations can make wise decisions when it comes to their liquidity strategy. The second point, focus on best-in-class liquidity. So what I mean by that, there's a lot of little tricks and gimmicks that some market makers use. They say, we'll help you with listings, we'll help you with getting investors, we'll help build your Telegram community. That's all well and good, and most market makers can help with that. I think when you are selecting a liquidity provider, the first thing you should look for is who is going to give me best-in-class liquidity. Everything else is a nice to have, but the best-in-class liquidity is a must-have. And that is something that a token project needs to focus on first and foremost. And lastly here, long-term partnerships, not short-term transactions. So what we mean by that is A liquidity provider needs to be engaged and obligated to a token project for a long-term period, not just for a month or 2 months or for a period of time that it is convenient, but token projects ought to be looking for long-term partnerships with their market maker and then obligating that liquidity provider to delivering a base level of service for the entire period of the mandate. So that's what we think the landscape kind of looks like now, and where we think people should be focused on. Now, in terms of looking towards the future, as a market leader, we kind of see our role as three-pronged here. Number one, our first and primary motivation is to put our customers and all of our partners first. We are looking to drive project success, drive their sustainability through our role as a liquidity provider and helping enhance that flywheel of adoption, liquidity, adoption, liquidity. The second is more as an industry kind of participant. This is a nascent industry. There have been a lot of bad actors. There still remain a lot of bad actors. What we want to do is raise the bar. We want to raise the bar on performance. We want to educate the industry on what is good market making, what is good liquidity provision, what should people look out for, and what should people run away from. That's number two. And number three, advocating for legitimacy and adoption. This is really, in a sense, a nascent industry. The way that the participants succeed is not necessarily by winning market share from other people. The way that we're all going to win is by growing the pie, right? We can all keep our market share the same, but if the pie grows by an order of magnitude, then everybody wins. So what we at Auros, we're very focused. We are focused on winning market share, but we're probably more focused on driving adoption, advocating for kind of legitimacy of digital assets and stewarding the industry to a better and more sustainable future. Just in wrapping up, our mission at Auros is to connect digital markets to global liquidity. And the way that we do that is we try to be transparent. We try to focus on the product and on the deliverables. And we focus on building long-term sustainable relationships with our partners. I can see a few of our team out here. They're all wearing Auros t-shirts. So if you want to speak to us, or if you want to speak to one of the team this week, come and find us. We're around all week. Good luck. Enjoy the week, everyone, and enjoy the Formula One for those people that are staying. Thanks.